Hi everyone, Alex here from Summerhill, just with another quick update. As I'm sure many of you are aware, the government handed down the federal budget earlier this week, and today's video will cover off on a number of the proposals that we view as being most relevant for clients. There are a number of positive announcements coming through, but it is important to keep in mind that the announcements made in the budget remain proposals at this stage and must be passed by Parliament before they become law. Now, starting with personal tax changes, the low and middle income tax offset was due to be removed at the end of this financial year. However, the government announced that it will extend the offset by 1 year, making it available for the 2022 financial year. The announcement means that most individuals can effectively have a taxable income of up to $23,200 without having to pay income tax. And there is a maximum benefit of $1,080 per person for those with taxable incomes between $48,000 and $90,000, before the benefit cuts out for those with taxable income above $126,000. Moving on, the government has announced that the existing rules that are used to determine whether an individual is an Australian tax resident are to be replaced with a simple test, whereby a person who is physically present in Australia for 183 days or more in an income year will be considered an Australian tax resident. There are different tax consequences if considered an Australian or foreign tax resident, so this is a welcome change as the new framework will be far easier to understand and apply in practice and will deliver greater certainty and lower compliance costs for individuals who may be living or working overseas for a period. Moving on, for those participating in employee share schemes, the government will remove the cessation of employment as being a taxing point for tax-deferred employee share schemes. Now, the purpose of this amendment is to remove the possibility that a tax liability may arise at a point in time before the employee actually has access to the shares under the terms of the share scheme. Moving on to superannuation, the already legislated increases to superannuation guarantee were not amended in the budget. Therefore, the rate of superannuation guarantee, i.e. employer mandated superannuation contributions, will increase from 9.5% to 10% from 1 July 2021. The government has announced that it intends to remove the $450 per month minimum superannuation guarantee income threshold. This means that employees of all income levels will receive employer superannuation guarantee contributions. So it will allow more people to start accumulating superannuation savings earlier. Beyond superannuation guarantee, there were also a number of announcements which are expected to commence from 1 July 2022 that could have a positive impact on the wealth plans for clients. The government has announced it will allow individuals aged 67 to 74 to make and receive non-concessional contributions, including under the Bring Forward rule, or salary sacrifice superannuation contributions without having to meet the work test, subject to existing contribution caps, of course. Now, the work test is a relatively arcane requirement for an individual to work for 40 hours in a 30 consecutive day period in order to be able to contribute to super. So it's a positive to see this removed. However, individuals aged between 67 and 74 years wanting to make personal deductible contributions will still have to meet the work test. These changes will provide more flexibility for those under the age of 75 to save for their financial independence through the tax-effective superannuation environment, and provide more flexibility for financial planning strategies such as a re-contribution strategy that are normally not available for clients in this age group. Moving on, the government has announced that it intends to reduce the eligibility age to make home downsizer contributions from age 65 to age 60. The home downsizer contribution rules allow people to make a one-off after-tax contribution to super for up to $300,000 from the proceeds of selling their home for which they've held for at least 10 years. Under the rules, both members of a couple can make downsizer contributions for the same home, and the contributions don't count towards the member's non-concessional contribution cap. So this is a positive change, and when combined with the non-concessional contribution rules, it could allow an eligible couple in their early 60s to sell their home and contribute up to $1.26 million to super in a year, or $630,000 for an individual, by making a $300,000 downsizer contribution and a $330,000 non-concessional contribution using the bring forward rule. So this allows those eligible to significantly increase their wealth in the tax-effective superannuation environment if they sell their home. Alternatively, where a client may want to contribute a much smaller amount to superannuation, it's going to be really important to consider what type of contribution should be made, whether it's a non-concessional contribution or home downsizer, in order to maximise flexibility to make further contributions in the future. Now, specific to self-managed super funds, the government plans to relax the residency requirements for self-managed super funds. Now, under the current rules, self-managed super fund trustees living overseas who intend to return to Australia at some point can be away for a period of up to 2 years, and the fund will still meet their central management and control test. Under the proposal, the trustee will be able to be away for up to 5 years and still meet the test. Further, the active member test will be abolished, and these measures will really simplify the rules and will provide self-managed super fund members with greater flexibility to retain and to continue to contribute to their self-managed super fund while temporarily overseas without jeopardising the fund's compliance status. And finally, and for a number of years, the government has offered a first home super saver scheme, allowing prospective first homeowners the ability to access up to $30,000 of their voluntary superannuation savings to be used towards the purchase of a first home. While there are a range of conditions that will still need to be met to qualify, the amount that can be accessed will be lifted to $50,000. We do not view this as a significant change, but it can help first home buyers in raising a deposit more quickly. As mentioned at the outset, many of these measures will not take effect until 1 July 2022 and must be passed by Parliament before they become law. However, it's never too early to start thinking about what sort of impact these announcements could have on your financial well-being. And of course, we will discuss the relevant changes with clients directly if any of the changes impact your financial strategy. That's it from us for today. As always, we appreciate your feedback on any content that you'd like seen in the community. Thanks.